our next speaker based on the itinerary, who is Mr. Ebrima Sawaneh. Mr. Ebrima Sawaneh, he is going to discuss on the accounting consideration of the pandemic, which is the COVID-19. As you all know, it's more of a finance forum. That's why we decided to bring in a topic that we are going to discuss on how the pandemic will affect our profession. What are the accounting issues that we are going to look at? How is it going to affect our recording, probably, and the reporting aspect? And as indicated on the screen, Mr. Sawaneh is a chartered accountant. I might not even need to introduce him a lot because a lot of people have known him within and outside the country. And it will interest you to know, again, he's the best-selling author and a speaker as well. He wrote a book on professional education, how to pass professional exams, which is widely shared globally now, not only in Gambia and Nigeria, but globally. And Mr. Sawaneh is currently working with Africa Finance Corporation in Nigeria as the Vice President in the Finance Division. He is currently residing in Nigeria, Lagos, and that's where he's actually giving his presentation from. This is all because of the lockdown. So I will want all the participants to join me and welcome Mr. Sawaneh to give his deliberation.
Thank you very much, Salifu. Thank you very much, Mr. Suwa, for a wonderful presentation. Good afternoon, wherever you are, or good morning. Like Salif introduced, my name is Ebrima Sawaneh, and I am very honored to join you guys across the globe to discuss about some of the accounting impacts from the COVID-19 point of view. We all know COVID-19 has impacted businesses around the world. It has stopped business operations and anything that stops business from operating. One of the people that are very much concerned are accountants, because our job is to report business performances. But what makes it more interesting and sometimes difficult is the fact that we have so many assumptions, we have estimates. If business is interrupted, it means there is a lot of things that would defeat the assumptions and estimates we normally base our reports on. So of course, COVID-19 has brought its own challenges for the accounting world. But whatever thing we are going to discuss here is going to vary from industry to industry, country to country, and even at the entity level. The list will not be completed because we can't talk about every possible scenario how COVID-19 is going to affect the accounting and financial reporting of various industries or companies around the world. But just to give you an idea of some of the areas we looked at, since we are going to base on IFRS, we will see that some of the accounting standards that will be impacted by the COVID-19 situation in various companies, just to name a few, in terms of post-balance sheet event, that's the events after the balance sheet date. In terms of revenue accounting, the areas of IFRS 9 for financial instrument, these are some of the standards that we have to look at as we prepare our financial statements for 2019 or 2020 or even the interim financial statements. To start with, let's discuss events after the reporting period, which we know that in financial reporting, in line with the IFRS, the day you are trying to prepare your financial statements, let's assume that you are preparing your financial statements as at 31st of December 2019. Between 31st of December 2019 and the day your financial statements are authorized to be issued, anything can happen there. That's the period we call subsequent event. And whatever happens there, they are generally classified as either adjusting or non-adjusting events. When an event is adjusting, we said you have to adjust your financial record. When it is non-adjusting and it's material, you disclose it in the financial statement. And adjusting, basically what we are trying to see here is that, was there an evidence of the condition existing as at the time or as at the end of your financial year? Assuming that somebody sued you to court as at November 2019, and the court awarded the case sometimes in January 2020. Such kind of situation would likely be an adjusting event, because as at the end of the year, the condition still exists, the case was there. So for issue of COVID-19, for us to decide whether it is adjusting or non-adjusting event, we have to look at the timeline of COVID-19 itself. We know that China reported the matter to the WHO on the 31st of December 2019 as an emergency, as a concern. But 30th of January 2020, that was when WHO declared as a global health emergency. So for accounting point of view, it has been generally agreed that the most important date is that 30th of January 2020, because that was when the World WHO declared it as an emergency. On the 11th of March 2020, WHO declared COVID-19 as pandemic. So what does this mean for those who are reporting either 31st of December 2019 or up to 30th of January 2020? For most people, I mean accountants, it has been agreed that for those who are reporting up to 30th of January 2020, COVID-19 situation is most likely going to be a non-adjusting event, because as of that date, the COVID-19 situation was not declared as a global emergency. But that means if you are reporting your financial statements as of 31st of December 2019, which is the case for many people online today, COVID-19 would likely be a non-adjusting event. What that means, if you have a situation, assuming you have a client that has gone bankrupt in February 2020, you do not have to adjust your book for that. Let's say as a result of COVID-19, you don't have to adjust your book for that. All what you have to do is to disclose. But if you are reporting, your reporting date is 31st of January 2020 and beyond, COVID-19 impact would be an adjusting event. Let's look at another concern that's coming out of COVID-19 is the growing concern issue. We know the ISA1 required management to prepare the financial statements on a going concern basis, unless you are thinking of liquidating that company, you want to cease trading, or it is almost impossible. And this going concern assessment has to be then done for each reporting period up to the time you issue the financial statement. Unlike the impact of events after the financial reporting period, going concern assessment has to be considered throughout the period until the time you issued your financial statement. So if you are here with us today, you have not issued your 2019 financial statement. When we say issued, we mean it's been authorized, usually by the board, to be issued. It means you expect your auditors and the management to work together to ensure that management have made assessment of COVID-19 as how it may impact your business. Let's take an example of the Virgin Australia Mr. Suwa gave earlier. So if Virgin Australia has not prepared their 2019 financial statement as of today, that means they will technically have to assess their going concern, and most likely they may not be able to issue a financial statement on a going concern basis, because they have been impacted seriously by COVID-19, which they are even thinking of. I don't know if they have declared that they are going into bankruptcy. The areas that will affect our going concern across the globe, including Gambia, travel bans and restrictions. If you are an airline company, you have to consider that is the travel ban and restriction affecting your business that it may even doubt your going concern. What financing challenges are you having? Are your major customers still functioning? If some of your major customers are having a problem, you too are expected to have a problem, most likely. Your suppliers too, you are buying from China where goods are not coming, your raw materials are not coming. Would that affect your going concern positions? Is there any government support that can dilute the impact of COVID-19 on your business so that you are even going to be there in near future. Your own liquidity, SWA spoke about the importance of having liquidity. Without liquidity, cash is the king, the businesses will not exist for that long. Another area of concern is about the impairment of non-financial assets. We know ISA 36, which speaks about the impairments, aims to ensure that assets are not carried more than their recoverable value. But ISA 36 also guides us that if you look at the impairments, we can look at the goodwills and indefinite useful life assets, which are intangible. We are supposed to test them annually whether they are impaired or not. But apart from that, other assets like PPE, property, plants, and equipment, we should test them for impairment when there's an indicator of impairment. Could COVID-19 be an indicator of impairment? Yes, it is possible. For goodwills, if the business environment has changed, the business climate has changed, it can impact goodwill. Remember, goodwill in IFRS, we don't amortize it. You only test for impairment annually. So if you have a goodwill on your books today, and the company or the cash generating unit you got that goodwill through has been seriously impacted by the COVID-19, for example, a major decrease in the export, you may have to impair your goodwill. But the one that is going to be most interesting is the properties, plants, and equipment, because we know that when a property is idle for a very long time, it may affect the future productive capacity of that PPE. Take an example of flight. I've learned it over a few days that at this stage it's costing airlines millions of dollars every month for them to just park their flight. Because when the flights are not moving, they are not flying, it impacts them a lot, particularly in the winter. So if you have a machine that's idle for quite a long time, what that means, it may affect that machine's capacity in the future. If such evidence exists, it may call for an impairment. So this year may be a bit challenging for all of us in the accounting professions. Of course, if the machine usage has also changed, you bought a machine for one purpose, and that purpose has seriously changed, it could also be an indicator of impairment as well. Again, you know, some of these things we can't say it with certainty because IFRS is a principle-based accounting. On the property, plants, and equipment for ISA 16, there will be another challenge we have as well. If an asset is idle, we are not using it anymore, what the ISA 16 is saying, we still continue to depreciate them. For those in factories, you have big machines lying down there who are not producing anything. It doesn't mean we are going to stop depreciating those assets. ISA 16 requires us to continue depreciating those assets. It means we will keep on charging them to P&L. And like I said previously, it may be also bring impairment on those assets. On the inventories, we know for valuation purpose, we do it at the lower of the cost of the inventory or the net realizable value. But the challenge you'll be having today is not the cost of your inventory, it's the net realizable value. Because of low sales, because of the lower price in the market, we know that assessing the net realizable value may even lead to a write-off for some companies. Imagine you are dealing with commodities. You probably have a crude oil 2 months ago supplies. You bought it at, let's say, $40, and today they are telling you that crude oil in the market is $30 or $21. So it means you are technically forced to write that value down because the ISA 2 requires us to use the lower of the cost of the stocks or inventory and the net realizable value. And the net realizable value is simply the possible selling price minus the cost of sales. Another interesting point for inventory costs is again how we are going to have an impact in terms of idleness of our assets. In this case, fixed asset. Remember, in accounting, we are allowed to take part of our production costs, even they are fixed, which we are called fixed overhead, and add them to the cost of inventory. For example, depreciation of factory, the rental portion of factory as a direct cost. But ISA 2 is saying that, again, when there is excess capacity, we cannot allocate them to inventory costs. Let me try to explain this a bit. You paid for a rent to produce goods there. On average, you produce 1 million outputs every month, and your rent is 1 million. So what that means, on average, you can add $1 or $1 to each of your outputs. But now that production has gone down, you are producing, let's say, only 400,000, but the rent is still 1 million. That means you have excess capacity. What ISA 2 is saying that you can't take that excess capacity of 600,000 and put it under inventory costs. No, you have expenses. These other accounting considerations all of us have to look out for as we look at the impact of the COVID-19 on our businesses. Another interesting part we see is on the IFRS 9 has an element called expected credit loss. Commonly we call it ECL, which is more like a probability of credit risk that we are trying to assess using a financial model. ECL is normally charged on debt type instruments which are not fair valued. And ECL, what makes it interesting, it factors both the past event, the current event, and the forecast of the future conditions. Normally, at the initial recognition of an financial instrument, we take a 12-month ECL. But subsequently, when there's a significant increase in the credit risk, the IFRS 9 require us to take a lifetime ECL. Here is the challenge globally, is that many institutions, including banks, may interpret mechanically that COVID-19 situation is a significant increase in credit risk. But the truth is that regulators, including the Bank for International Settlement and even some security regulators, including the ISAB as well, they are saying that we should not mechanically apply IFRS 9 ECL models we may have developed, because we saw that banks have given moratorium. If they give moratorium to all the customers they have, either by the request from their central government or voluntarily, it does not necessarily mean there is a significant increase in credit risk. What we have to understand, the risk of default on a loan from IFRS 9 point of view is not just for only one period. It's about the lifetime of the loan. So we should be careful on that. Just because there's a credit risk changes on the credit terms, it does not mean that all the loans are going to default and we try to charge ourselves a lot of ECL during this period. And one thing we have to also factor in is the fact that government is supporting, in some countries, some of these moratorium or some of these debts. So therefore, it's important we are very careful when it comes to the application of ECL during this COVID-19 situation in our financial statements, either interim financial statements during the year or at the end of the year. There is another area we need to look out for, which is the fair value measurement. Fair value measurement under IFRS 13 aim to reflect three things: market participants' views, market data at the measurement date, as well as under the current market conditions. So the challenge is going to give us is on two sides. For those who are using observable input level 1, as we call it, like stock market price, IFRS 13 is saying that we should continue to use those level 1, even if the market rates or price are volatile. You can't say, oh, that place, the market rates are volatile, in that case, I won't use it. So if you have, let's say, a stock or an equity investment on your books, and that equity is listed, price may be going down, so you will have to use those prices. I think that one is very clear. The most critical one is the level 3 fair value measurement, which is the unobservable market input. So we have to be very careful in terms of judgments. We have to be very careful in terms of estimate, because some of the items we may be using in those as input into our valuations for unobservable input may be difficult to get at this point in time. Let's move to revenue accounting, IFRS 15. Again, this one also gives us two major challenges, possibly depending on your company. The first one is collection. At this time of the environment, you may want to continue selling. But in terms of determining the transaction price, in line with IFRS 15, one of the key things is that there must be probability for you to collect that new sales. What am I trying to say? If you are selling to a customer today, IFRS 15 is saying that one of the tests is that we should be assured that we have the ability to receive our consideration from that client. So what it means, if you sell to somebody who is virtually looking like a dead company, probably you may not be able to record that sales if it's a credit sales, except when the person paid or the company has paid the money and it's not refundable. So this makes it very complicated for those who normally make sales on credit. It is a larger volume of sales around the world. Most of them are on credit. So if you are selling to some company, you have to be sure that you can receive your money. The second part is the variable considerations. For example, cash discounts and bonuses. They may lead to reversal of previous revenue. Let me explain this because variable consideration is a bit complicated when you come to IFRS 15. If you give discount to someone, let's say a cash discount in November 2019, you told the company that I'm going to sell $10 million to you, but you can take 10% discount if you pay within 90 days. From November, that will end sometimes in February. Historically, your data shows that 80% or 90% of your customers do not take such kind of discount. And based on that, you are allowed in IFRS 15 to take 90% of the revenue and account for it because you have data and you have estimated that this is what has been happening in my company. But because of COVID-19, some of those customers may take you on that discount to save their cost. So remember the scenario I gave here, you may have taken 90% of revenue already in the previous year. 90% of revenue you may have of the sales of the previous year, assuming that they won't take that discount. Now that there's COVID-19, they accepted a discount. What is going to lead for you to do, you may have to reverse such consideration. You may have to reverse such sales revenue. Similarly, again, on the variable considerations, some companies may have sold something to a client and said, you have right to return it back. So clients may return those goods back to you. This may lead to reversal of revenue that we are recognized in the previous accounting period. So we should watch out for that part as well as we account for transactions in 2020 during this COVID-19. There are other areas that are also critical. Government support. Government is supporting businesses around the globe. Some companies may not have any policy on how they handle government support. We have to be so in line with ISA 20. Are those supports a grant or are they assistance? Assistance normally comes in a form of tax relief or other tax mechanisms. If it's an assistance that relates to a tax, we have to look or read through ISA 12 to be sure that we are accounting for it properly. If it's a grant which fall under ISA 20, we have to be sure that we are complying with those grants because grant normally comes with a condition. So in so we account for it. Do not just roast an account for government grant as a revenue or reduce your expenses. And at the end of the year, your auditors come and tell you you haven't meet those conditions, so you have to reverse it. You know, when you record something as revenue, everybody will say, oh, it's fine. But when you don't reverse it, everybody will blame the finance professionals. Another important area is any potential breach on our borrowing covenants. For those of the companies which most likely you will have, you may have borrowed money from banks and they gave you some conditions. Will it be certain ratios or certain liquidities? If you are breaching those covenants, it is important you engage the banks before you break them so that you may have to restructure your transaction or your facility. Because if you default on most covenants, they normally create a condition where the whole loan or borrowing becomes payable on demand. And remember, when we are presenting financial statements, we normally have current liabilities where those debts which are due within a year are reported, but we also have non-current liabilities, some people call it long-term borrowings, which are classified for different reasons. If a loan becomes a breach in terms of covenants and it becomes payable on demand, without any other agreement, it means we have to classify that loan as a current loan, as a current borrowing. So it's important we look for those conditions as well. Again, our 2020 budget, you will agree with me, there is of very little relevance to 2020 budget, which we drew in 2019 due to changing circumstances. Budget is a KPI for most institutions, and it's also a very important motivator. So therefore, it is expected as finance leaders, we lead such initiative to discuss with our board, our senior management, or our CEOs to see how best we can revise the budget. Let's not wait until last minute, because we know 99% most companies may not meet their budget because we are all impacted one way or the other. We have to also look out for controls at this stage. Remote working policies, if you don't have one, think of developing one. Because people are going to be working from their house, you have to ensure you have standard systems there, or else you are going to be prone to increase in fraud that is happening online globally. They are going to be prone to cyber attacks. And when they attack you, they can get data, either for your customers' data, your own business intelligence data. So we need to work with the technology partners to ensure that we focus on those controls. So the control now is beyond in our houses. It's beyond where our offices are. It is a global network of internet systems that are talking to each other. That's why it's important we protect our institutions as well. What are some of the next steps we can do as finance leaders? Let's read and review our accounting policies. If you are reporting in line with international financial reporting standard, check what are the mechanisms that you have to factor in as you prepare your financial statements, either for 2019 or for your first quarter or for half year, depending on whether you report to a stock exchange or not. But it's important you review your financial accounting policies to ensure they are consistent. When we are planning, we need to start using scenario-based modeling. Let's try to look at various scenarios of what may happen to our business. Worst case scenarios, best case scenarios, on the normal scenarios. Let's try developing such kind of scenarios and try to visualize these things, discuss them with our other team members. We have to also manage the talent risk. You have people working from remote. I've been working home for the past 1 month. You may have some major projects going on, and you may have some key workers working on those things. So you have to see who can support each other. People are getting sick. I believe accountants are part of those patients who have already catch up with the COVID-19. So we need to see how best we support managing our staff. If you are working in office right now, you have to start leading how best you move your employees to start working from remote, because it's very important. It may affect every country around the world. Another important thing, we should start assessing the working capital need and the liquidity need of your business. Look for a way to secure new sources of funds. If your country or your government is not coming, propose a mechanism or a committee, a private sector committee, to knock on the doors of your government to see how best they can support businesses. You may knock on your bank's doors, how best they can support your businesses. But one key thing that is important at this stage is about transparency. It's about telling the truth so that people can help you and your institution. We have to also look at our cost profile to see how best we can manage costs due to falling revenues. Revenues are going to fall for most industries. So our work is to see which costs are essential. Do not just block any kind of cost. Some costs are very critical for the business to continue. And that's why you need to have a look at a more long-term strategic view. Communicate, communicate, and communicate. We have to communicate with all stakeholders, from the other business heads to the board members, to regulators, to our suppliers, to vendors, to customers. We have to communicate with all of them to know their circumstances. Know what is happening to your supplier. Know what is happening to your major customer, so that you don't think somebody is going to pay you by May and the money is not coming through and start giving you liquidity constraints. So we have to continue communicating. I cannot overemphasize that area, which is sometimes very good in finance. We think we have everything in hand, but we have to engage. That's why we now call it what? Business partnering. Overall, I think what we need here is the quote from a gentleman called Milton Friedman. He said, "Only a crisis, either actual or perceived, produce a real change." So for us as accountants, COVID-19 pandemic has changed every aspect of our business. However, it is also an opportunity for us to reflect and start building a more digital finance function. Thank you very much for your kind attention.